Hi everyone, this is Himanshu Singhal and welcome to whatsnwhys. Today we are discussing on the type of loans, and in this video we'll discuss when you see loans from the lens of FDD professions, how you should see and what are the type of loans and what is it that you are required to do or answer after the DD of borrowings. So in terms of loans, we generally know that there are two type of loans: term loans and the long-term loans and the short-term loans. And then from the FDD perspective, we see term loan as long-term loans, then short-term loans, and loan from related parties. Let's talk about each one of them one by one. So in terms of long-term loan, we have project loans, debentures. Debentures could be also of two types: non-convertible debentures carrying a fixed percentage, and then there could be convertible debentures. In terms of short-term loans, we have CZ and OD limits. In that you can really utilize how much you want to use at any particular point in time up to a specified limits, and your interest is charged on the amount availed. Then we have rollover loans, which are for a period of 8 to 10 days, 15 days, 30 days. The name of the instrument could be different basis geography and the banks, but these are rollover over the period. Like you can get these loans to roll over after a fixed duration. Then you have specific kind of credits which may be termed as packing credit or bill discounting. In that case, you may have vendor bill discounting or your own invoice discounting. So in case of vendor bill discounting, so what you do is, let's say you are required to pay 100 rupees to someone today, and the creditor is pressing you to make the payment. You make arrangement with the bank that bank pay them immediately, and you pay the interest to bank at a particular rate. So this type of credit is for about up to 3 months generally. And for your invoice discounting, if your debtor are not able to pay right now, you may make an arrangement with your banks and allow your debtors to pay in installments, and generally that in that case debtor bear the interest. We don't. Now you may have credit cards. Generally, it's not there, but in some companies we have seen that they obtain credit card with certain limits, and this is for regular day-to-day operations. And the credit cycle is similar to what we get 45 to 50 days somewhere. Now, what analysis you are required to do, and what are the answers that you need to give to your investors or your client? Okay. So first step is balance check as on closing date. Here the closing date means like if you are doing DD of 2.5 years, or let's, for example, we are sitting in November right now. So you may be doing DD of September period. So September period become the closing date here. So you can check the closing balance either through confirmation or statement, but I generally prefer to check once from the agreement schedule as well. So if there is any revisions, then you can know that there is some kind of revision, and if your balance is not matching as per the agreement. So balance will not, like if you have taken 100 rupees loan, the balance as on books may not be 100 because you would have paid some principal, or your interest may have been accrued and put into moratorium, and then that becomes the principal. There could be a lot of combinations, but the agreement will specify how much is your loan outstanding. And from the agreements, that's why I recommend that we always check that the agreement balance as on closing date matches or reconcile at least with the agreement. Second step is the repayment schedule. So we should definitely check the repayment schedule. So repayment could be defined in the agreement in the form of some EMIs or fixed principal payment over the duration of the contract. There could be 1,000 combination out of this. They may say that you will pay monthly X amount, then in the first year, then the X amount, Y amount in the second year. They may give a fixed EMI, lot of combinations. But what you need to why you need to do this is because your client needs to estimate the future cash flow. Okay, and it may give them a negotiation point. For example, if a company is stressed and they have a big repayment coming out, so they will be very much interested in closing out the deal, and It will give your client an edge. So you should definitely focus on the repayment schedule. Now the financial covenants. So we need to check whether company is compliant to the financial covenants that the agreement has given. Generally, when company don't meet the covenant, it is considered as event of default. And in each event of default, there is the loan may become repayable unless you obtain a waiver, which is upon the discretion of banks. And financial covenants, that's why are very important to check. Now, security clauses. Generally, loans are pledged by the fixed assets, current assets, such as receivable and inventory balances, and share of promoters, or it may be also be guaranteed by guarantee of some of the promoter entities or promoter themselves. So we should check and present in our report definitely what are the securities. Generally, in a summary form, we need to understand and but we need to highlight it accordingly. Now there are some special clauses which we need to be mindful of, is like event of default. Uh, your there could be interest complex terms, conversion terms. We will discuss about those particular terms in subsequent videos. Now let's talk about short-term loans. What you are really required to do in that. So all the points that are relevant for the term loans are applicable for the short-term loans. Just as in summary form, if you tell, balance check was on closing date. The repayment, obviously, in the short-term loans, repayment will be quite in a near future. Then the financial covenants, security clauses, and event of default. In addition, in short term, what you're required to do is do the headroom analysis. Headroom analysis is like if you have 100 rupees of limit, how much you can really utilize, and over the period, how much have you been really utilizing. Both the thing we need to present. In most stress companies, what you'll find is the loans are these limits are utilized at max capacity, like 98-99% as of closing dates. But many times it happens is that the company are not allowed to utilize the full limit, and the full limit is contingent upon the company maintaining certain kind of debtor balances or working capital balances in the books of account as on closing date. If they don't they don't have those kind of balances, so bank generally limit the available limit to a certain extent. So there is a concept of sanction limit, then the available limit, and then the utilized limit. You should look it through three buckets like that. And we generally prefer a bar chart depicting how has the utilization trend of these short-term loans. Now, talking about the vendor bill discounting, it's so vendor bill discounting or invoice discounting, it is not generally visible in the borrowing schedules. You may have to look through aging of trade payables and some disclosure in the financial statements. Only then you will be able to identify whether company has these kind of adjustments. So in subsequent video, we discuss more on advanced topics. Thank you for watching, and do like and subscribe.